afternoon. Thank you for joining us today for ROK Resources year-end and operational update. ROK trades under the ticker symbol ROK on the TSXV and ROKRF on the OTCQB. With us today from the company are Bryden Wright, who was just promoted to CEO and President. Congratulations. And Jared Lukomsky, Senior VP of Land and Business Development. I know you guys have been crazy busy, so it's been quite a while since we've had a good update from you. So I'm looking forward to going through the deck and getting a good presentation. And then there will be room for questions after the presentation. You can enter them in the Q&A box, and I will turn it over to you, Bryden.
Sounds good. Yeah, thanks, Jess. Thanks, guys, for having us. It's been a little while. We just put out our 2024 year-end financials, which I think we provided an update in alongside our reserves. So I don't think too many surprises with those, but give a bit of a summary for the year. So 2024, we had primarily focused on a maintenance budget, and so 2023 was a year of big growth for us, and we increased our production by about 50% in the second half of the year in 23. Went from about 3,000 barrels a day to, I believe we exited over 4,500 barrels a day. And so when we came to 2024, our focus was, transitioned a little bit more to debt reduction, cleaning up our balance sheet. And so we did that. And I must say, in light of recent price fluctuations and declines on WTI, we're pretty happy with that decision. So, 2024, we spent just under $20 million total capex, 17 of which directed toward drilling operations, and that's what you see on this slide. Just had over just over 31 million funds from operations, and averaged about 4,000 barrels a day. So we increased production a little bit year over year, while spending significantly less, about 35% less than the prior year. So we're able to stem declines, did quite a bit in the way of workovers and optimizations, a few reactivations, and just firmed up some of the operations and some of the assets that we had picked up in previous acquisitions. So the year overall was very successful. We reduced our net debt by about $8 million, I think by over 40%. We exited at about $10.5 million of net debt at year end. So again, a very successful year from that perspective. We currently sit at just under 4,000 barrels a day. Haven't spent any capital really in Q1. We haven't been drilling. We plan to begin drilling subject to oil prices in late Q2, early Q3. And so, yeah, overall, a really solid 2024. And, in light of everything that's happening geopolitically, both in Canada and the US, we're just kind of waiting to see, post-election, how things unfold, and then go from there.
Now what is your current decline rate then?
So our decline rate prior to this reserve report, so last year, was about 27%. That's come down in that 24% range. So we did, reduce that year over year, which was positive. Again, we didn't have a growth-oriented budget last year, so we didn't add a lot of flush production on. But yeah, we're sitting in that 23-24% range corporately.
And with this, I'm sorry, I was just going to quickly ask, with so much work you spent on workovers, et cetera, amalgamating the assets, you've been able to bring your op costs down fairly significantly.
Yeah, so when we did the Whitecap acquisition, so for those that have kind of followed along to our story, we did a big acquisition, our transformative one in 2022, where we acquired all of Federated Co-op's assets. And then in 2023, we followed that up with a Whitecap asset swap. And with that, we brought on a lot of Southeast Saskatchewan, kind of high GOR Midale assets. And the operating costs on those were quite high with our gas processing agreements in place. So we've been able to reduce that year over year. We're right around $30 a BOE corporately. We do see that continuing to reduce, into 2025. We've been focused quite a bit on kind of streamlining a lot of our operations. Obviously, always looking at chemicals and, always looking at operator changes and things like that can really move the needle on, widespread assets. And so we have been able to do that. Q1 is coming in, I believe in the kind of $27-$28 range. So we're happy to see that. So, our goal is to be sub 30 for 2025. Production levels will partially dictate that as well.
Cap table, I think the big piece of news was, recall back in March 2022 when we raised our last bit of capital, the $17.25 million to purchase the Federated Co-op assets. It came with a warrant, which was had a strike price of 25 cents a share and a term which expired in March of 2025. So we've since seen those warrants expire, which now represent the equity holders of ROK. There was no dilution attached to that. So us as shareholders currently own roughly a third more of the company than we did prior to March. So we've got basic shares outstanding of 220 million. We've got options at 19 cents with an average strike price around 27 cents. And you'll continue to see alignment with management and board of directors, with us roughly owning 17% of the company, whereby, we've maintained our position in terms of shareholders, and have not sold any significant blocks over the course of the last 12 months. Again, history for those that aren't aware of our name. In the past, we've built and sold companies. We've had 4 private iterations, growing organically from 0 to as high as 2,400 BOEs per day, exiting all assets being in Southeast Saskatchewan. ROK, as Bryden mentioned, we're currently sitting at 3,900 BOEs per day. Important to know, we've raised $24 million within ROK. Back in March 2022 was the 17.25 million that we raised. We have not raised equity since because we're sensitive to, insiders, management, shareholders, and not diluting for the purpose of diluting and growing to grow. Rather, we're trying to extract as much value as we can out of the asset that we currently have today. So we'll continue down that path as we focus on M&A, hopefully heading into 2025. Saskatchewan core area consolidation, as mentioned in 2022 into 2023, we had a number of acquisitions. We did 5 separate acquisitions over the course of time, focusing on Southeast Saskatchewan, again, an area that we understood really well, building and growing and selling 4 different private iterations. You can see with this graph, we've taken production in some of these acquisitions and we've grown it from 100 barrels a day to 600 barrels a day, which I think sort of highlights the strength that we've got on our technical team and our ability to extract value out of the current assets that we have. And we continue to focus on sort of tuck-in acquisitions, small M&A, continue to add freehold leasing, crown leasing, and positioning ourselves that if or when oil prices pop, we've got the ability to grow out and what we drill, what we think to be smart wells, and continue to grow in certain areas.
And I think it's really important to note, how important technical strength is in Southeast Saskatchewan. Well, it's not geologically easy to find things. So you guys are probably one of the top teams doing it, I would say.
I can agree.
I think we've been in this basin, Jared and I, since inception of our private companies, since kind of the start of our careers. Cam, for the majority, I'd say, 80% of his career has been in Saskatchewan. So we do think our technical team understands it very well. We drilled a lot of the wells that we ended up acquiring back from Whitecap. And, as technology continues to advance and drilling styles and orientations and everything changes and evolves, we believe that we have some great assets that we can go and capture value from. So, appreciate that, Jess. I do think we're, a team that knows our assets and the majority of Southeast Saskatchewan quite well. So looking into 2025, I guess we are through Q1. We put out our guidance, I believe, at the end of February. Oil was $70 a barrel. Things were we're seemingly stable. Obviously, that's changed significantly since then. You know, we saw $58 oil not too long ago. So a lot of volatility today. At $70 oil, we put out a budget. You know, we drilled 9 wells, kind of maintained production in that 4,000 barrel a day range. Again, a similar year to last year, funds from operations of 30, CapEx of 19, you know, and we would basically reduce our debt, you know, year over year by about $5 million, $4.5 to $5 million. So, you know, at $60 oil, I think that changes. And as we, you know, get through the Canadian federal election and try and get a grip on, you know, whatever Trump's going to do with tariffs and, you know, understand the macro as best we can, you know, we'll remain flexible with our drill program, with our capital allocation over the course of this year. And then, you know, we provided an upside kind of $80 budget and what, you know, what the asset could look like if we did go out and deploy a little bit more capital. And I think, you know, the one thing that I want people to kind of understand is as we do that and we drill and spend, you know, $30 million at a higher oil price, we're still able to maintain very low debt to cash flow. And, you know, you can see the bottom 0.2 times debt to cash flow. That's currently where we sit today. We've reduced our debt an additional, you know, from year end where we were just over 10, we expect to be closer to 5 million net debt at the end of Q1. So, you know, we've been just expeditiously reducing debt. And I think the timing couldn't have been better. And I know a lot of people in the market wanted us to grow last year and continue just to pump money into the ground. And, you know, we were vigilant and, you know, steadfast in our belief that reducing debt and giving ourselves more flexibility was our focus. And, you know, we're happy that we did that. So we're sitting today, like I said, $5 million or so of net debt, access to $22.5 million on our line, and an ability to go out and really ramp up when the timing's right, but also look at, you know, tuck-in acquisitions, look at opportunities to grow via M&A. And as we move forward and get through kind of, you know, our year-end, our annual bank review, potential for, you know, additional flexibility, be it NCIB or things like that. So a lot of things on the table over the next few months, corporately.
When will you be debt free?
So, I mean, that obviously a lot of levers, you know, a lot of things that go into that question. You know, what's oil price? Are we spending capital? If we were to just sit in $62 oil today and not deploy kind of drill capital until July, August, we would be debt free by then. If we were to get out and start drilling in May, obviously we'd be utilizing some cash flow and potentially a little bit of our bank line, if we were to get aggressive. But if we were just to kind of stay the course as we sit today, Jess, we would be, you know, we could be debt free by that July, August timeframe.
Bryden, if I could add as well, Bryden talks about levers that we could pull. And we talk about our hedges, which I'm sure we'll get into in terms of a discussion. But, you know, another lever is we're sitting at roughly $6 million worth of debt. And roughly a week ago, mark to market, we were $5.5 million to the good in terms of our hedges. So, you know, again, I think there's things we can do. But as Bryden mentioned, I think we've created some incredible flexibility for us in our balance sheet in terms of sort of how we've navigated 2024 and so far the start of 2025.
Yeah, it's very prudent so far. I mean, none of us knew what this was going to happen, but you know, it's been great that you didn't blow your brains out in Q1, and and then all of a sudden we have forecasted $58 oil, which I mean, I'm assuming, I mean, we're already seeing activity slow down.
Yeah, exactly. And who's to say we're not in a lower price environment for the next 12 months? I mean, no one really knows at this point in time. And I think, you know, just being in a good spot like we are today on our balance sheet, you know, gives us confidence in terms of how we can grow the company, and just, you know, essentially how do we add value on a per share basis for shareholders, and that's our goal. One of the things that, you know, that will lend itself to that growth and that share accretion is, you know, our multi-lat drilling that we're looking to, you know, focus on going forward. Those that are familiar with Southeast Saskatchewan or really Western Canadian oil and gas over the last 15 years, fracking became such a key part to many companies' stories and growth and the ability to access, new oil. You're starting to see a shift kind of back to just conventional multi-lat drilling. So when I say shift back, multi-lats, 1 or 2 leg, 2 or 3 leg rather wells, that's been around for a while. You're starting to see an increase in the number of laterals now across a variety of basins. And I think, the Clearwater was kind of one of the first basins that we saw this in. You're starting to see different, fishbone type designs or just, 8 to 10 leg wells. So, if you look at our areas, Glenview and Steelman, for instance, in the Frobisher, 2 to 3 leg wells, maybe 4 leg wells, I think would be the max that we would go on Frobisher wells. It's pretty standard for us to drill dual leg wells. That hasn't been, that's not new. So we're just going to continue that. There are some incentives from royalty perspective in Saskatchewan now for multi-lat drilling. So, you look to take advantage of those where you can. In the Midale, so Pinto, and this is just one example. We are moving, and we did this in our reserve report as well at year end, away from fracking, drilling 2, 3, 4 leg wells. So we're starting to see bookings, across the industry, not just ROK. Most companies are doing this and kind of converting their fracked inventory into multi-lat drilling inventory. You get incentives, like I said, on the royalty regime in Saskatchewan, higher NPV10, similar EURs, overall better economics with a lower capital cost on a multi-lat versus a frac. So, we are excited. We drilled 1 multi-lat in the Midale last year. It was a successful well, and there's, we have 50, 60 locations that in the Midale specifically that we like for this type of application. We also included, sorry, go ahead, Jess.
I was just going to say, how much does that bring your costs down given you're not fracking? Yeah,
so historically, I think the last well we drilled and fracked would have been around that $2 million mark, all in, drill, complete, equip. Now we're in that, depending how many legs, $1.4 to $1.8 million. You could drill a 4 leg lateral for 1.8. You could drill a 3 leg lateral for probably, 1.4 to 1.6, depending where you are, depending on the tie-in and things like that. So you're dropping your costs considerably, anywhere from, 25 to 35% probably on average. And then, Dodsland, I just wanted to mention, we do have some assets in the Viking in Southwest Saskatchewan. We have some primarily non-operated 50% interest across a couple different pools out there, and we've recently drilled a well with a partner out there. We have additional locations with another well-known oil and gas company that we probably will drill in 2025. I think that there's been a delay on the program in light of pricing recently, but overall, these Viking wells, very, very established pools. It's a single leg well, low capex from, $1 to $1.2 million. Lower IP rates, but kind of very flat production curves. So it's an area that had been very underbooked in our reserve report. So, excited to get some wells drilled out there and just add value on the books.
And this is an area that you hadn't really talked about before much. So this is newer.
Yeah, it's not a focus of ours for sure, Jess. It's an area that we, we have production, we have some operations. It wasn't an area that we operate. And so it wasn't a focus, and, continues to just be kind of on the periphery. But in terms of, location count and inventory and reserve growth, it should add some value to the company over time.
Okay.
As far as location count goes, we maintained, I think we added a few locations year over year. Understand that we didn't have a growth year, so it was more of maintenance and drilling key critical wells to prove up technology or prove up play styles and kind of our application of multi-lat drilling rather than growing the reserves or growing the inventory. So we sit with we're showing 110 locations booked on this slide. We do have additional locations, and this is more of our core areas. But we do have quite a vast inventory right now. Our stay flat drilling requirements would be around that 10 wells a year. So if you think about that, we have 10 plus years of stay flat drilling inventory quite comfortably. And that's primarily across the Frobisher and the Midale in our Saskatchewan place. So looking at our actual results from 24, we drilled 6 Frobisher wells, 1 Midale well. Just simply, we're based on our type curves that we use internally, which are, typically at 10 to 15% reduction compared to our McDaniel engineered curves. We outperformed that type curve by roughly 20% on average. So, overall a successful year. We had some really great wells. We drilled in the Frobisher. We drilled, like I said, that 1 Midale well that came on, around 200 barrels a day. So we're happy with that, and continued to just drill strategically. Prove out, like I said, drilling multi-lat and adding value and pushing plays forward when the time is right and when oil prices support that.
And in your mind, would you say you would get a lot more aggressive? I mean, going back to your budget, you're saying sort of 10 at 70. Would you get a little bit more aggressive at 75, let's say, or?
Yeah, perhaps. I mean, I think anywhere from $70, $80. A lot of these wells start to pay out quite quickly.
Yeah.
I think as you trend up to that $80 mark, we can definitely increase that capital budget and drill some wells. It's all about, on a play-by-play basis and well-by-well basis, what price point makes the most sense to go and drill these wells and bring them on flush production and produce those barrels as opposed to leaving them in the ground for better days. So yeah, I would say it's kind of a stepwise thing, Jess, as you go, you get to 75. I think a few more plays make sense. We don't have a big expiry profile, so that's not really a driving force for us. But obviously that's considered as we go.
Yeah, and you don't want to give away your resource at these prices. I mean, there's no point in that.
No, exactly. Yeah, like I said, we were sitting around that $70 mark last year. We drilled 10 wells, and we were sitting with a little bit more debt than we wanted to carry, and we wanted to have that flexibility to do other things, and so we made that decision. So I think that will continue to be a focus for us. But now sitting kind of where we are today and paying down debt quite rapidly month over month, I think it gives us the room to get aggressive when the timing is right.
Okay.
This is just a little bit more showing a bit of our inventory on the open hole multi-lat. Again, it's primarily, this is a Midale map, so you can see, we have quite a few locations in that core trend, Glenewan, Openshaw, Pinto area. And, we have a number of those locations planned for this year, prices pending. And, again, it's just about proving that application out. Similar map. This is just more on the Frobisher side. You'll typically see dual leg wells, like I said before. This is Albright Huntoon for the most part. Not as much. The Frobisher, you see a little bit more kind of localized structures. Not as widespread of inventory. But the nice thing about the Frobisher is when you drill these wells, you can get 4 to 6 month payouts. Very, very attractive recycle ratios and economics. And we've built companies on the Frobisher and the Midale for a lot of years, and so we really like having both plays kind of at our fingertips. And a key focus is improving our Frobisher inventory. So we're always looking at land sales. We're always active on strategic tuck-ins with inventory and things like that. So continue to be a focus of ours going forward.
Is there a lot for sale as far as like Crown or otherwise in this area?
Yeah, I would say.
Sorry.
Yeah, I would just say, Jared, you can jump in. Land postings. There's always things to either react to or post ourselves when we see opportunity. Land sales have, the capital being deployed on Crown land sales has continued to be quite, I guess, aggressive. If there's a section of land in a core area. Companies are paying up for that, and that's because of the value that's associated in the upside. So yeah, there's Crown land sales always, there's always value and there's always opportunities there. We're very active on freehold leasing as well.
We allocate roughly $1.5 million worth of budget dollars towards whether it be freehold or crown acquisitions over the course of the year. The other thing in the M&A space, given the volatility, I think it's difficult to do deals to match buyers to sellers. There is product available. There's some pretty significant pieces of this that are or will be for sale that we continue to evaluate and put the time and energy in. Not only evaluating from is it a good fit for us? Does it technically make sense? Is there upside, et cetera? But also understanding what the funding mechanisms look for us. And, I think we've gone down a variety of paths to understand what that could look like for ROK. And I think what we're waiting for is volatility to subside, and then, understanding if we can match, our desire to buy with a seller. And, obviously no guarantees on what that looks like. We look at a number of transactions or potential transactions over the course of the year. But again, I think what we're waiting for is volatility to subside in order to generate whatever that may look like for ROK going forward as well.
I was going to say, with the current volatility, given the the Vermilion package that's out there or whatever, or do you think that may get pulled? Or do you think they'll still transact given their debt level?
Yeah, my instincts would be anyone that's desperate that needs capital is obviously a seller. But if you're not desperate to sell today, I think you're waiting for a better understanding of what the market's going to look like. So my belief is that any dispositions are sort of put on pause for the time being, which is fine.
Yeah, like this market is just not conducive for doing deals. It's next to impossible unless, to Jared's point, there's a seller that has motives and needs cash and and wants to vend something. But from what we've seen, it's going to take a little bit of kind of stability in the market before you start to see things transact, and that's both from a buyer and seller standpoint. So hopefully that happens over the next few months. So I won't get too technical, but one of the reasons why these assets have always been so appealing to us as a group is because of the stacked geological formations. You look at kind of from top down, you look at the Midale, and then down through the State A and the Frobisher. A lot of these plays are structural plays where you see these structure in the same areas, and you're able to target both formations, and we've had success doing that. So this is just more of adding some technical spice to our presentation and showing investors and anybody interested what we're targeting. Some people may have seen or heard of the State A. It's a bit of an emerging play. It's a formation that people have seen and had oil shows in for decades, but until the multi-lat drilling has evolved to kind of where we are today, it's really never been successfully targeted and produced. So we are seeing companies out there drilling multi-lat wells in the State A. It's kind of like a Marley. It's like a Midale Marley in terms of rock lithology. It's a dolomitic kind of finer grained rock. So we are seeing some success in that space lately, and we have some State A targets that we really like on our own lands, and so you kind of add that into the stack potential, and you're looking at 3-4 different zones in a lot of our areas. So again, it's exciting to kind of see this trends continue to progress, and our assets are looking quite attractive as we move forward.
And you've got a good land position in
that. Yeah, we have a lot of land. Like I said, a lot of drilling inventory to keep the company flat, and as we add both at the drill bit, and like I said, we believe in these assets, but we come from historically we come from a build from kind of zero and grow organically. So we have an inventory, but we're always exploring. We're always looking for opportunities to grow at the drill bit on new land and new plays, and corner shotting existing plays, and so that will always continue. We believe we have a really good prospecting group, so I think we can grow both on the M&A side, drilling up existing inventory as well as adding new inventory. This is just one additional slide on the open hole multi-lat versus fracked, and it just shows drilling density and how that I think is still going to evolve over time. You're seeing anywhere from kind of 75 meters up to 150 meter interwell spacing, or interleg spacing, I should say. And I think that will still, we'll drill wells, and other, competitors will drill wells, and we'll see over time, what the drainage looks like. But really what it does, it allows you to put in 2, 3, 4 legs into a previously, fracked single leg well, and obtain, the same EURs, ideally quicker payouts, reducing your capital, as I've already talked about. So, a trend that will continue, and something that, hopefully we'll have some good results on as the year goes on. I won't get into detail on our reserves. Our reserves our PDP was relatively flat year over year. We grew our 1P and our 2P on the oil barrel basis. We had some declines in our gas asset and KBOB, and overall gas reserves went down, but our focus, has been and will likely continue to be oil, unless we see a big run up in gas that unlocks some of our KBOB potential. But overall, we had some modest growth on our oil reserves, which was kind of the goal going into the year. So our hedge contracts, we're in a really solid position hedge-wise. We, with our banking with National, we do have a hedge requirements, and that's what you see here. So we're hedged roughly 75% out for a 12-month period. I would say that's, it's a little bit less than 75 today. It's more like, 65 to 70 today. But that, every year we add in additional hedges, and basically it's a rolling 12-month option. And Jared already mentioned our hedges today are worth, anywhere from $5 to $6 million mark to market. So, we're in a really good spot there. Again, hedges are great when oil price is low, and if oil price is high, then then we're happy as well, because then we can continue to bring on new barrels unhedged. So, as it sits today, hedges are in a strong position, and financially, ROK's in a great spot.
We're seeing like pretty good prices for natural gas right now, even though the basin is fairly oversupplied. Would you lock in more gas at this price, at these prices in the summer?
So what our hedging strategy has been is, within obviously the covenants and the restrictions that we have, we hedge as much gas as we can, and hedge a little bit less oil. And our, when you look at strip on gas and contango versus the backwardation of oil, we're very bullish hedging gas. And for us, our gas production, our gas revenue rather, is only about 6 to 7% of our overall revenue. If you include liquids in that, it's closer to 12, 13%. But, our oil makes up the bulk of our value in terms of our, our cash flow and reserves. So I think for gas, it's prudent for us to hedge, lock in some good pricing. You're close to $3 as you look out 1 to 2 years here, and whereas on oil you're sub $60 as you look out into next year. So yes.
Yeah, how do you hedge into that?
So, yeah, it's not something that we're super bullish on doing right now. So that's an ongoing conversation with the bank in terms of how they view hedging out, beyond, out into Q2 2026, because, I think hedging at current pricing out a year on oil isn't the best decision. So we're having that conversation. But yeah, to answer your question, gas prices are looking pretty strong, and I think we'll continue to try and maximize those hedges.
Perfect.
So overall, I think catalyst wise, I think ROK, we put ourselves into a position to have flexibility, as we've said. We did pay down debt. We were able to grow our inventory modestly. I think, we understand our kind of side, our portion of the basin in southeast Saskatchewan as good as any company out there. And so because of that, we're going to look to, to grow it in a number of ways. And I don't think you'll see, or you won't see us, go out and deploy meaningful capital on a drill program at $60. Just doesn't make a lot of sense to us as a group. But as oil prices, look to increase, which, we're very confident they will over time, we'll have the ability to pivot and grow when that happens. And I think, in the meantime, we'll be looking at other opportunities. We've been having discussions on NCIBs and doing things like that, return of capital to shareholders. So those conversations will continue to happen. Bank reviews coming up in the next few months. So, I think in the short term, you'll see us, obviously it's breakup right now, so we won't be drilling. And as we get into May, June, and things start to warm up, and we'll see where pricing's at, we'll hopefully have our bank review done by June, and we'll have some levers to pull at that point. And like I said, flexibility is very key for us, and I think we put ourselves in a spot now where we have that flexibility, and we'll continue to. So, we're excited. I think we have a lot of upside on the asset, and we want to get out and drill, but we want to do it in a prudent manner.
Well, you can pivot very quickly. So you've set up a lot of good plays. So that I think that's key to focus on. So I mean, if we do see improvement, you can pivot. Otherwise, it's you're creating more value with an NCIB than you would be drilling. So
yeah, exactly. And you've seen our share price. The market perhaps didn't love our plans of kind of maintaining as opposed to growing last year. And then you couple that with just overall market sentiment being so poor, and money not pouring into the bigger players, let alone us smaller guys. So, the stock price has been hit pretty hard, and in our opinion, not indicative of the value of the company at all, or the value of the upside, and the reserves. So yeah, it's been a challenging market, but overall we're happy with where we're sitting today.
And it's been that way for really since last June, really.
Yeah.
Right. So, and
exactly.
Now we're seeing such massive, outflows of capital at this point, that it's hard to get much attention when you're micro cap company, much like or a large company. I mean, people are just pulling money out of everywhere, so it's a bit of a big problem.
Yeah. So yeah, we're just looking at all of our opportunities to increase shareholder value, and increase that per share value, and what are the ways we can do that. So yeah, we'll hopefully have some more updates for the market over the next few months, and get out and chat with investors a little bit more as well.
Well, I think you're doing everything correctly and managing your capital extremely well. So, and I can sleep at night owning your stock, unlike a few other things that I own. So, and it's the cheapest it's ever been. So, I mean, even with the oil down at these levels. So, I think it's a tremendous buy here, but again, until the world gets figured out, it's hard for we're seeing.
Yeah, we understand that, absolutely. Yeah. It's a tough time to invest in anything right now, but I think if you just look at what we can provide at current levels, even cash flow wise, with our hedges being well in the money, I think there's a lot of room for uptick in our stock, and we're confident that'll happen over time here.
And like you said, you didn't grow a lot last year, but you set up a lot of plays and added good locations. And I think you're doing all the right things. So it's great that we could get a more a good fulsome update, and we'll just keep people abreast of what's happening. So
that sounds good. Thanks.
All right. Thanks for your time.
All right, thanks everybody.
We have no questions because I asked about 8,000 of them. So anyway.
Okay.
Okay.
All right.
Thanks, guys.